Walk us through the numbers. How should we be reading them?
Okay, so we continue to expand at moderate kind of levels here. But if you notice all the indexes, they've only moved 1.5, maximum 2 points. They're not, the headline indexes, the ones that go into the PMI, they're not moving dramatically. So we've had a definite shift of adjustment here. Let's talk about demand first. New orders continue to contract slightly. No big deal. An expert in this area kind of advised me that, hey, look, when the new orders are above 40, you don't have to really worry that much about a recession coming. So that's a really interesting point. New export orders came up a bit, which is really good. Backlog is shrinking because new orders are slowing down still because we have over-ordered over the last year and a half. And I think the only thing on the demand side is that the customer inventory number kind of crept up closer to 40, which is an indication that at some point in the future, customers aren't going to need as much inventory. So, hey, demand's solid here, I think. There's some indications. We had panelists reporting that things were softening again, but that softening could be well outside of a normal order stream. So the story is really on the supply chain side this month. Well, we're sitting there now at 55.2 on supplier deliveries. The situation is getting better, and it's demonstrated by the fact that prices are coming down too. Those kind of follow together.
Well, to that point, Tim, on prices coming down, it's the biggest fall in the prices paid index since 2010. What is the signal there as to whether or not that decline is durable?
Well, it's the fourth largest drop since we started keeping numbers in 1948, which I think is really cool. So, but I think a lot of it has to do with energy coming down over the month, where we also see steel slowly coming down too. Aluminum prices are coming down. Copper prices are coming down primarily because of the softness in China. But we seem to be coming into a level now that's much more towards equilibrium. The issue that is still in front of us is that lead times really haven't changed much. And I'm really waiting for the lead times to start to contract. We had lead times come down a little bit on CapEx, but not significant. I'm hoping in the next 2 or 3 months we'll see lead times come down. Coupled with the prices coming down, you'll see the new order rate pick up again.
Tim, just to stay on that number, the prices paid number, the rate of change, as you've indicated, as Kelly's indicated, is substantial. But what you're saying is basically you think it's going to come down and now stabilize. Is that the right read here? Or do you expect the next month's number to deliver another sizable downturn on that figure as well?
Well, I don't really think so, because I think we're at a kind of an equilibrium here. We're getting close to that. I mean, the 60 number on the prices is maybe 2 to 3 points higher than you really want it to be for equilibrium. You want the supplier delivery number to be 55 to 59. That shows a normal stress between the supply and demand. You want the prices number to be kind of 55 to 58. We're not quite there yet. I don't see a drastic fall off. Like I said, that new order number staying above 40, significantly above 40, leads me to pause and think that we're in a pretty good place. I mean, the other issue that's happening here is that we had a lot of comment from the panelists about manufacturing inventory. And they're concerned about the future, no doubt about it. They don't want to get stuck with all this extra inventory at their facilities or at their supply base. So that has a lot to do with the new order rates dropping because we've kind of over-ordered. But they're positioning to make sure the working capital can be positive in spite of a downturn at some point in the future. So they're being very cautious here. Last month, we reported that the new order rate slowing was primarily because lead times were so extended and prices were so high. This time, there was a clear indication in the survey comments that they are concerned about being stuck with a bunch of working capital, i.e. manufacturing inventory, that they're not going to be able to relieve during a normal cycle. So that's kind of the story for the month.
Okay, Tim, well, of course, it is Monday. By the end of this week, we'll be talking about the non-farm payrolls report at this hour. So on the employment side, that index back up near 50, just a tenth below it. What are you seeing on the labor pressure side for manufacturers?
Thanks, Kaylee. Great lead in. So we're still 7-to-1 companies hiring versus attriting. There's no comments really about layoffs at this point. You see it in the media, though, that a lot of large companies are positioning for layoffs. Some are laying off. The majority of them are indicating that they're going to trim their overheads or their general overhead headcounts in the future. They're not really saying this week, next week. So that's a positive thing. Our panelists are still hiring at a 7-to-1 rate, and that 1 out of the 8 is really attriting out or freezing. So we're not in a layoff environment at all. They're still having difficulty. The quits rate is still elevated. The general headline comments around labor are still indicating that they're still struggling with getting people and they need more. So, and that's primarily why the production number really hasn't come up. But contracting employment number is a result of the panelists not being able to add to the headcount on a month-over-month basis. It's not because they don't have the demand.
Be interesting to see what the JOLTS number says tomorrow as well. We'll review that data at this time tomorrow. Tim, final quick question from me. Manufacturing data outside of the United States are slowing rapidly. You're seeing it. We saw it in China. We've seen the data out overnight. The European data as well is also indicating a fairly rapid industrial slowdown. What is the relationship with what is happening ex the United States to what is happening within the United States? Can you draw a line between those two? Because at the moment, it feels very different.
Yeah, I can give you an overview. So, China contracting, they've been very sluggish now for a year and a half. And China contracting really means that Germany is struggling too, because German exports go to China in a big way, and China's single trading partner is probably Germany from the standpoint of capital investment. The numbers that you see in the European theater are different from the ISM numbers. They tend to overweight new orders and underweight inventory. So you can't really align them one for one with ISM's numbers. We don't run in the European theater. Our numbers are all U.S. We equally weigh the 5 sub-indexes that go into the PMI number, and we've been doing that for, 70 years. So you can't really do a direct correlation. But, hey, Europe, no doubt, is not strong, but it was encouraging that we saw new export orders come up in the month. And China, I think, is driving that German-Chinese situation. And I'm not sure how that's going to be resolved in the short term anyway.